Welcome to Shifting Ground, the podcast of the Orbis Journal of World Affairs, brought to you by the Foreign Policy Research Institute and the Sam Nunn School of International Affairs at the Georgia Institute of Technology. Join us every other week as our editors connect the pages of Orbis with the issues of the day.
I'm Nick Vosdev, a professor at the Naval War College and senior fellow at the Foreign Policy Research Institute.
And I'm Larry Rubin, an associate professor at the Sam Nunn School of International Affairs at the Georgia Institute of Technology.
Together, we serve as editors of Orbis, the Journal of World Affairs.
Each episode will speak with scholars, policymakers, and practitioners about the forces reshaping global politics, international security, and world affairs.
You can find this and future episodes of Shifting Ground on our website, orbisjournal.org, Spotify, Apple Podcasts, and all major streaming services. Please note that the views expressed by the hosts and participants in this episode are their own. This is Shifting Ground.
Welcome to this episode of Shifting Ground. Today, Larry and I are pleased to welcome Rachel Ziemba to talk with us about some important changes that are taking place in the geo-economic structure of the world. Everything from how countries are adapting to sanctions, what's happening with the dollar, and critical supply chains. Rachel is a geo-economic and country risk expert focused on how government policies impact energy and resource markets. She runs Ziemba Insights, an advisory firm which supports clients in their macroeconomic scenario analysis and policy due diligence. She's also the senior advisor for economic statecraft at Horizon Engage, an adjunct senior fellow at the Center for a New American Security, and a non-resident fellow at the Gulf International Forum. She also teaches international political economy at New York University's Center for Global Affairs and writes regularly at the Weaponized Economy Substack. We're very pleased to welcome Rachel to Shifting Ground. Just to give our audience a sense of what draws you into this line of work. You are involved in looking at how commodities are traded, how supply chains are put up, but you do this not only from the policy side, but also with a sense to the commercial side, because policymakers can talk till they're blue in the face about what they'd like to see happen, but it does take the business community to get involved. So what drew you into this?
Yeah, I think I was always, or for quite some time, I've been interested in how governments reshape markets, how I started out studying international political economy, the politics of dollarization and currency choices. And then I found myself working for government, working for the private sector, tracking emerging market and frontier trends. And so when I shifted gears and decided to be a little more policy involved, I still wanted to keep a corporate advisory hat on, and I wanted to keep connecting groups that might not be talking to each other, whether that's in the think tank community, whether it's, government actors, and of course, a wide range of market participants and corporate investors, because I think often those groups don't necessarily understand each other. And so when I started doing this some time ago, it was maybe a little bit of a harder sell. Now everybody wants to have a geo-economic expert or a geopolitical expert. And even things I've thought for some time that a lot of my work, as I say, looks at how governments are reshaping markets. And that was my way of explaining how I could look at sovereign wealth funds and the use of sovereign balance sheets to catalyze investments and shift returns, but also sanctions, which are designed to, by the US and others, these coercive policies that are designed to stop an actor having access to markets. So, in a way, there's sort of two sides of a barbell. And I think it was an odder thing. So, 10 years ago, 8 years ago. But now I think people see the US using many sides of the balance sheet, and not only the US, many countries as well, both traditional, what we'd call advanced economies and emerging market. So I think it's less surprising to think that we live in a time of a weaponized economy.
It's actually really interesting is kind of how things have evolved with the role of sanctions in foreign policy. And I was curious if there are certain turning points in your career that you remember either in response to events that you had to reframe or your career this way, or it was more of, oh wow, I was always talking about this, which it sounds like, and now's my time, and come listen.
Yeah, well, sometimes I think it's easier to look back and to say, seems like it falls into place. But I think at the time you start by, seeing a puzzle or somebody asks you to understand a puzzle. In retrospect, I look back, I was in graduate school just after 9/11 and doing some work on remittances and working for a professor that was working on Sri Lanka. And in retrospect, we had to look at how the post 9/11 sanctions, the Patriot Act, those other measures were impacting remittances. And at the time, I just thought it was an interesting project to work on, and this was the new state of the rules. But many years later, I look back and said, oh, that was my first experience tracking sanctions, tracking how risk profiles were shifting, how that reinforced other vulnerabilities. I mean, in a way, on the sanctions side, I really fell into it in about 2010, where I was working. I was focused on the Middle East, on emerging markets, and I was asked to do some modeling about how sanctions pressure on Iran might impact global oil markets. And then, of course, we had sanctions that led up to the JCPOA period of pressure, and then we had sanctions on first Russia and then Venezuela. And so there was a number of years there where there was a significant chunk of my work that was on sanctions and then export controls, even as I was also working in other markets that were not really encumbered in that way. But still, you have these elements. And then on the more positive statecraft side, governments using their balance sheet to support new areas. I kind of fell into that work even earlier than with sanctions because I was trying to track how governments in the Gulf, Cooperation Council, and Asia and elsewhere, how they were using their windfalls, their economic windfalls, and trying to develop their economy. And so I started doing that work almost 20 years ago, tracking petrodollars and the like. And so, they've been threads throughout my work. But one of the things I find really interesting right now is that, especially in the area of critical minerals and critical supply chains, we see countries like the United States, countries like Canada, Australia, really thinking about how can we use our balance sheets to catalyze the private sector, to send them a message that 5 years from now, 10 years from now, 30 years from now, there will be sort of demand for key minerals, to sort of get that started where the market signal is broken, either because of the nature of the market or in some of these cases because China has been willing to cross-subsidize and has a lot of efficiencies. So some of those same tools in learning that a sovereign wealth fund and the other side of the world had developed are ones now being considered by the United States. Doesn't always manifest in the same way, and there's different transparency and different elements, but I do think this is all about governments using their balance sheets and to support policy goals, and so I think this is a shift.
3 years ago, you took part in a symposium for Orbis. We attempted, after 1 year of the Russian invasion of Ukraine, to try to get a sense of where global order might be headed. And in your contribution, you said we're in a period of great economic policy experimentation, particularly in East and West Asia, as well in the Americas. And you were saying that all of these tools that are now out there, that, as you said, we're drawing you into this field. We're kind of seeing new things develop. We're seeing a sense of development around supply chain, sanctions, currency use, all the use of public money to try to incentivize the private sector, so on and so forth. What I thought we could converse with you about is to take what you wrote, which I think is as fresh today as it was 3 years ago, which shows you, I think, that the extent to which you were seeing these trends, but perhaps to expand on what has changed or evolved in a variety of these things, from supply chains to de-dollarization and the like, over the last several years, and where you think things might be headed. And if I can kind of start with the first one that you said about looking at this trend about greater links among sanctioned economies, that countries that are being sanctioned by the United States and by Europe are finding ways to work and route around those sanctions and connect. And you know, today in 2026, what are you seeing in that area in terms of U.S. sanctions maybe not being as so decisive an economic blow, and lessons that are being learned, and particularly in this case by Russia and Iran?
Yeah, I think that's right. I mean, the trend, and thank you for giving me the chance to revisit this and to reread that piece. Some of it was more prescient than I'd remembered. I mean, again, by themes, I think it also marks, even as Orbis is going through its new iteration, but that space to sort of think ahead, think on these, on these trends is incredibly valuable. At the time, I was looking and saying, well, the United States is trying to use sanctions and export controls and other restrictive policies on larger and larger economies. China, to some extent, but especially Russia. This is, a country, one of the sizable oil, sort of oil and gas producers. And they were doing it at a time also, we had a peak where, over, 20% of global fuel liquids were sanctioned, until quite recently. And that ebbs and flows a little bit on how much Russia can export and other things like that. But that is a meaningful, a meaningful shift. And at the time, I think we were just sort of grappling with this case of, could, what sort of new parallel networks would be created? So we had, there had been countries like Iran that had used shadow fleets and evasive infrastructure to get their oil to market. That was shared with countries like Russia, and then, really took off on steroids. And in part because of China's willingness to skirt, the U.S. rules, and incentives to create these parallel networks, but also because at the end of the day, the U.S. And allies were really concerned by what the rightly, by the economic impact of what happens when a 10 million barrel a day oil producer would be sending all of its oil offline, right? And, I mean, in a way, the thing that we didn't want to, the policymakers didn't want to grapple with back in 2022 and 2023 is something that every day the Strait of Hormuz is closed, and it's still mostly closed today when we're speaking. We are seeing that play out in real time, and it's not only oil and things that are sort of the case, but this swing that we're seeing in the physical markets is something that back in 2022 the U.S. government was particularly trying to avoid. So, but all of it, I mean, I think we see an environment where the more countries that are sanctioned at the same time, the larger the countries are, the more likely you are to end up with parallel markets. Now, when the U.S. together with the Europeans, with the G7, said together we are going to put sanctions on Russia, that reduced maybe what would otherwise have been, could have been a flight from the dollar, right? Because from a Russian perspective, if they had central bank reserves in euro sitting in, well, mostly Brussels in practice, or if they had them in Japan or in Ottawa, it didn't matter. So diversifying into these different G7, G10 currencies, it was the same from a sanctions perspective. And I think had that not been the case, I think we might have seen more sanctions related, hedging. Now, from a dollarization perspective and de-dollarization perspective, I think we sort of have two competing trends ongoing. One is that there are a lot of big holders of assets that don't want to get trapped and have their assets frozen and the like. But that is offset by the fact that the US has the deepest, most liquid capital markets. And it has, especially on the equity side, so much innovation in the public and private markets, and people want returns. So, depending on who you are as an investor, you might care more about the liquidity piece or the return piece. But you kind of end up with this, the acronym is TINA, there is no alternative. That has kept capital flowing into the United States. But, people like Daniel McDowell in his book some years ago, really documented, this on the margin diversification and on the margins that additional friction. And I'd also note there are an increasing number of actors that are buying dollar-like assets that are a few steps removed from U.S. Treasury jurisdiction, right? The work of, Abe Newman and Henry Farrell of Weaponized Interdependence fame, uh, highlight that one of the reasons for this sort of financial sanctions power is both, they're one of the aspects is a panopticon effect, that if everything is sort of touching the U.S. and the Treasury can see it to some extent, you can, sometimes you got to be really fast. And it's not always as easy. There are also, other aspects to that. But, if you are holding on to USDT on, Tether, you might end up with, Tether has to own a lot of US Treasuries, but it's offshore. What's the regulatory jurisdiction there? And so there are different uses of currency. So I guess that's a bunch of long ways of answering your question, or I hope, or some of your questions.
As a follow on, I mean, this is something Derek Pugh turned me on to about Tether and the ability for them to, as you said, operate offshore, whether they hold treasuries or they claim to hold gold, and that they can transfer that gold into dollars to ensure the one on one. I think it's some really fascinating things, and I think from our concern for Orbis as a journal and a place that connects the policy world with these trends, is that the policy world may not be as agile in catching up to some of these changes.
So my question is really, how do you think the sanctioned countries have learned from this experience? You mentioned a couple of examples before, just kind of going in, playing that other side of what have they learned? Have you seen it evolve over time?
And I think that's a really important question to ask. And sometimes I think in a US and even partner country perspective, sometimes there's so much focus on we're going to do this and we think they're going to do that. But, the cost benefit or other calculus can be very different. And as economists, a lot of the people I work with, including myself, we might look and say, well, creating a whole alternate network, that's inefficient, it's going to cost more. But if your only way of trading is to engage in that additional cost, well, then that's worth it. If it gives you optionality, you could maybe say the same argument of, why invest in why should Saudi Arabia invest in two alternate ways to get its oil to market? Or invest in surplus capacity, and sort of surplus that you should have ready to go. So, again, I think in a policy context, we know that optionality and reserves and other things like that are incredibly valuable, and it can be worth that over time. So I digress from your question. So I think they learned that, you could create and insulate banks and some financial institutions, that developing, China has invested in building out their alternate payment system, CIPS, as an alternate to SWIFT. Now, in early days, if we go back 5 years even, there's a lot of evidence that CIPS was an alternate payment system that still used SWIFT for messaging. So it maybe wasn't quite so much an alternate. Now there are more banks that are directly plugged in, and there might be some evidence that it's easier to make those point to point transactions. Um, I also think that what tends to happen is that some of the very political actors and sometimes military actors that are almost often the target of sanctions themselves often become more powerful in a highly sanctioned economy. A market example might be like the too big to fail. But in a sense, even if the energy revenues of a government actor were the ones targeted by sanctions, those revenues are so important that they would be protected. Or the military structure in Iran is so important that the IRGC actually took over a wider set. So, I mean, maybe that's not a lesson directly from the sanctioned economy, but a lesson that we can learn from how sanctioned economies, interact. Um, and I think sometimes that in these gray areas of these alternate payment systems, you also end up with other quasi-illicit trade that goes on, whether it's weapons, whether it's drugs, whether it's other things like that paradoxically, once you're taking some risks, and again, I think this also dovetails with the use of some of these alternate payment systems or alternate stores of value in countries where it might not be a sanctions risk, but it might be a lack of trust in fiat currency risk or inflation risk or something like that. And I think there's also, the lessons learned not just from sanctioned economies, but those who want to trade with sanctioned economies and the sanctioners. And I've been addressing this sort of starting out as the US and countries like the US as a sanction sender. But it is worth, of course, remembering that China sends sanctions too. China sends coercive export controls also. But it doesn't have the financial leverage that the US has. It has maybe trade leverage if we think about sort of critical minerals and magnets and other things like that. But the lessons I think learned by places like the United Arab Emirates or Turkey or South Africa or Brazil, trying to think about, well, how can they straddle trading with everyone, taking advantage of price advantages, and not being in a position where the US or someone else can dictate their foreign policy and economic policy. Now, even the Europeans, I think, have had times where they didn't want to be in that box. I'm thinking back to the period in the first Trump administration when the US withdrew from the JCPOA. The Europeans tried to create a swap situation with Iran called Instex. At the end of the day, there wasn't enough to the supply, the risk reward wasn't there. But I do think we see a lot of countries wanting that optionality. And that's when, the tipping points, the tipping points might come.
Well, one of the things again in your Orbis piece is that you charted all these trends and said that this is what's happening, and lo and behold, it's happening as you laid out, and certainly your piece is up and available on the Orbis site. So we encourage people to be able to see how good your analysis was. That it's very worth going back to look at. There's something else that you had touched on that I want to then come back to as a trend that's accelerated, which was we've really seen this move away from laissez-faire, let the markets handle, the markets are the best, judge of handling trade, to much more government intervention. And you've talked about the sanctioned economies having to be learning these things because they're under pressure. I think this point you've raised about governments in the middle powers essentially saying we want to preserve our options. But even the United States is now, and its partner is looking for partners and allies to really help with this. And so I'm struck by something that you had just posted a few days ago, and maybe to comment on that as well as the meetings you're having now and what you're hearing, which is that we've had, as you said, we've seen a flurry of critical mineral announcements. governments getting involved, governments pledging money, sovereign wealth funds pledging money, but now trying to sort out a bit of the noise from the reality, which is it's great to have an announcement, though. We're going to create this new project, and a sovereign wealth fund has pledged X amount. But what are you seeing now in terms of this sort of state, quasi-state capitalism that's emerging that the U.S. seems to also now be embracing to some extent of having state money or quasi-state money to prime the pump for projects to essentially signal to the private sector that someone has skin in the game here. What are you seeing? I mean, how much of this is still noise? How much of it is still PR? And what's actually happening? And are people actually delivering on their commitments? Are the wire transfers happening?
Yeah, I think a number of the wire transfers are happening, though not as much has been pledged. We have I have tracked this more in the critical mineral space, which of course is a broad set of minerals. Right, the U.S. has about 60 on its priority list right now. At which point, at what point, I mean, if everything is critical, is nothing critical, or just there's an element where there are different solutions for different minerals, right? Some are traded, some are not, some are more diversified in their supply chain, but quite a wide variety of them. You have a Chinese processing choke point whereby China control or sort of China accounts for 85, 90 something percent of processing. And it's not just basic processing, but the sort of the supply chain thereafter. So Japanese and Korean companies that might be building magnets, they are relying on Chinese reagents or technology in the supply chain. So in a way, US government and others getting involved. I mean, I mentioned Japan. Japan was very early to kind of have to grapple with these issues because China effectively briefly cut them off from rare earths, almost 15 years ago. And then they really had to think about their supply chains in a different way. And they put a lot of capital in a rare earth processing plant in Malaysia, partnering with an Australian company. It had many issues along the way, but yes, is up and running. And in from the U.S. perspective, and I would say this is something that military strategists and procurers and energy security people started sounding the alarm on quite some time ago. It was only really 5 or 6 years ago that I started saying, oh, I really should be paying more attention to it on two grounds, right? One was these are energy commodities too. But this is a supply chain. So yeah, what's really happening? So they're trying to solve an issue, which is partly a temporal shift, right? A demand for some of these minerals might be strong over time, but nobody wants to pay a premium to have that optionality, or companies don't. If you talk to a major, not oil, car producer, an OEM, they're saying, sure, we want to have a non-China reliable supply, but could you provide it to us at the same price that China provides it? Right. And that is an issue. When we were sort of, I think our critical mineral policy was much more an energy transition policy in the Biden administration. The temporal challenge was how to deal with the fact that over time, demand for, say, lithium was going to be high. Today, it was not. And oh, by the way, China had added a lot of processing capacity, so the price was very low. So in a way, government was sort of trying to step in and incentivize and de-risk to have a pathway to sort of think about where we might be by 2030, 2034. Now, what's happening today is that instead of just providing loans or grants, the US government in particular is saying, well, if public capital is at risk, we should take an equity stake, and there both should be maybe some upside for the taxpayer if there's an upside. And I think I could get behind that. the question mark is, to some extent, always an issue of picking winners and losers, right? Rather than sort of supporting the whole industry and providing, broad rules. And then one of maybe prioritization. And then I think there's a separate layer of questions about, transparency and how some of those winners and losers are selected. Are more of the companies that are selected close to government actors? I mean, that's a separate set of corruption adjacent questions that I'm sure you get into in Orbis and other spaces. But overall, I think that we end up with a market failure because, or in the position of a market failure because of a policy failure in which China really just dominates this market, not just because they subsidized and cross subsidized, but also because they invested over decades and developed the whole supply chain. So there might well have been subsidies along the way, but those who were saying, oh, China just steals technology or China just subsidizes would miss the point. So here what we're seeing now is entities like the Office of Strategic Capital under the Department of War deploying significant funds. We're also seeing industrial policy funds allocated by Congress for semiconductors being redeployed, in this way. We're also seeing a really, activist export-import bank and development finance corporation. One of the important innovations, in my view, in U.S. development finance in the first Trump administration was Congress passing and creating the Development Finance Corporation, which could move away from just loans and take equity. And that can be good for recipients as well. And then in just last year, the potential capital it can deploy has gone up to $210 billion from about 60. Now that sounds like a lot, but when you compare it to what the Chinese development banks can deploy through the Belt and Road, this is still pretty small potatoes. I mean, or maybe medium-sized potatoes. I think, and then the next set of issues is, so the U.S. is doing this. There are bilateral agreements with Australia on the one hand and lots of other countries. How does this coordination look? And I'm not saying governments can solve all the problems and connect all the dots, but the key question is also how do the tools come together? And I do think there's still a lot more pledges, and typically investment cycles and political cycles don't necessarily line up. And I mentioned earlier that in the last administration, the focus of critical minerals was energy transition. Now it is very much defense industrial base. There are some battery metals that are still important for battery storage systems, for example. But the risk is, does a new government come in and the rules change, the incentives change? Because that's really detrimental to business when the rules change. Now, at the same time, I'm a believer that governments have to learn and businesses have to learn, and you have to explore. So one takeaway from this recent, the post was based on a recent report that I put out that some students at the University of Toronto developed for me. And it looks at 8 countries and a bunch of Canadian provinces. And one of the takeaways for me was that the Canadian government realized that their existing fund was missing some projects and said, you know what, we're going to shift the focus and we can now invest in last mile road construction, which maybe seems pretty basic, but that road and infrastructure to the isolated mine, like that was a problem. So we can't expect that sitting in 2026, we're going to be able to foresee all the issues that are going to come up by 2028 or 2030. So I think that balancing act is going to be really important. So maybe setting broad priorities and then providing space to sort of, maybe we're back to experimentation here, see what works, but not just throw out and change priorities full scale every time we turn around.
And that was definitely part of the advice at the close of your Orbis essay, which is we are in this period of experimentation. Can I just ask as a follow up to that again? What are you seeing in terms of the appetite of investors, sovereign wealth funds, and others to want to fund experimentation? Because it's one thing to say that we should experiment, but is there a sense that the situation that we're in now calls for this? And I mean, just the point you had raised earlier about Saudi Arabia discovering that, yes, having multiple egress points for oil turns out to have been a good thing to have if you want to, if the strait is blocked. So again, what are you hearing? What are you seeing? What's the reaction on the business side?
Yeah, I think on the business side, some businesses, we've had a wide range of shocks over the last 5+ years, relating to uh, the pandemic, of course, and realizing that even if you had different suppliers, if they're all down the street from each other, that might not be as diversified as you think. You could look at countries like South Korea that diversified among the different Gulf countries for their oil. If the strait is blocked, that's not real diversification. Even China, actually, though China had a resiliency, had a big reserve buffer, larger than some other countries. Um, so I think maybe where they're interested is, um, you know, eh, in having a bit of a diversified portfolio, right? I think those investing in venture capital type investments often will do this. Is they will try to pick good managers, pick interesting ideas, with the understanding that probably not all of them are going to play out. But if some of them play out, it could, hit the big time. Now, that can be difficult to scale if you're trying to deploy many, hundreds of billions of dollars, hypothetically. But I do think it can be something in the balance sheet. The key, I think, here sometimes is making sure that these government funds really are patient capital. That's always been the argument that sovereign wealth funds make. They're not specifically just tied to the reporting structure, a quarterly reporting structure. They can invest and be there through the long haul. Sometimes in the past, we have seen, and maybe not pull out of illiquid investments in that time horizon, but sometimes move in public markets in that way. But I think some of it's a portfolio approach. What we are seeing, I think, across a lot of sovereign investment vehicles is a shift away from investing in public markets into private markets and into strategic investments that are linked to domestic economic development. I mean, Saudi Arabia is probably really key case in point here, partly because they have a large population and sort of real needs and economic development elements. To puts them in a very different position than sort of smaller population countries that are their peers. But there's a real legacy of doing this in Asia, Southeast Asia, places like Singapore, for example, to sort of really think about how do you invest in things abroad that are supportive of domestic development? How do you manage well local assets so that you can then sell them off and then put money into other new projects? How can you develop those management skills? Those are, I think, some of the issues at play. Now, as I've said, sometimes the challenge is that it's a question of a gap between financial returns, economic returns, and economic returns could be about employing the population, and that could be a really useful thing. I mean, as we're speaking, now in the middle of April, just this week, the Saudi Arabia's Public Investment Fund rolled out a new strategy. Some of it, when I read it, didn't seem that new to me, probably just because they've been briefing on it and enacting it for much of the last year. But their focus is on really thinking a little bit, trying to only invest in things that have economic returns. So maybe there's going to be a little less golf and a little less football. We'll see. But that question mark of how do you calculate whether it's their own versions of double bottom line investing, all of these things. And I do think, there's a bit of a through line that I see from what the Saudis are trying to do now with what the Qataris and Emiratis were trying to do 15, 20 years ago, of thinking about, well, we want to develop X sector at home. Let's go out and invest and learn from companies abroad that are market leaders. Maybe with our investment, they will want to set up shop here with us. Maybe they can be incentivized. But that's definitely a strategy that's been tried. That doesn't always work, work perfectly. And then there can be questions of governance along the way that I don't want to ignore. But I do think that's the case. And then I guess maybe leaving you or for this point with some issue, I think this question mark about how do these balance sheet policies fit in with tariffs and the use of some of those tools. And in a way, that's been a bit of a through line in I guess both of the since the first Trump administration, but even in the Biden administration, areas that government funds were supporting in the U.S. were also protected by tariffs. And now I think we're seeing the Trump administration do something much more dramatic, which is try to use tariffs or tariff concessions as leverage to pull in investment. And the jury's still out on that one. I think that sometimes just the tariff costs, the tariff structure is not the only facilitating environment you need. And I think they don't always do themselves favors in the implementation, just because of the specific elements of the way deals are done. But this idea, in a way, what they're trying to do, and this is to use a range of tools in the toolkit. And that's something people are always asking me, what if there's a change in government and Congress? What things might go back to normal? What reverts back? I think there's a variety of things that would shift if there was a Democratic president. Of course, it depends what type of Democratic president or what type of Republican president. But I think that some of these industrial policy tools, some of these using a lot of tools in the toolkit, that's going to stay the same. What might change is how the priorities that were deemed key to the national interest and what partners were prioritized to try to meet those goals.
In this era of uncertainty, can you give us one question that you think, or maybe issue that you think people should be paying attention to, or some question that you have on your mind that you want to have answered?
Yeah, I mean, I think this question mark about what partnerships make sense, what kind of public-private partnerships make sense. I'm kind of dodging. I think even in areas that I think are a real priority right now, like the export of the AI tech stack, thinking about having more flexibility, maybe in learning from the private sector about what areas of innovation might either need government support or not sort of just locking ourselves in too much to anticipate where the needs are going to be, where the innovation is going to be 5 years from now.
It's been wonderful to have you with us today. Rachel, thanks so much for your time. We've learned a lot, both Nick and I, and I'm sure all of our listeners have too. And we look forward to many more insights and thoughts from you in the years to come.
Thanks very much. I'm so glad to chat with you folks and to revisit this. And it sort of inspired me to go back and to think about something. Hope the listeners enjoyed it, but I definitely enjoyed this conversation.
This has been an episode of Shifting Ground, a podcast of the Orbis Journal of World Affairs. For more information about the articles mentioned in this episode, please visit us at orbisjournal.org. Until next time.